You open a checking account, pay $0 for it, and never think about it again. You assume the bank is just being generous, maybe competing for your business. That feels obvious. But the real answer is far stranger than that. Your free checking account is one of the most profitable products a bank offers, and you rarely see a single one of the ways it makes them money. Once you understand how, you start to see that the account isn't free at all. You're just paying for it somewhere you never think to look. Let's start with the oldest trick in banking. Your money sits in that account, but the bank doesn't let it sit still. The moment your paycheck clears, the bank quietly lends a large portion of it back out as mortgages, car loans, credit card balances, charging borrowers interest far higher than whatever tiny amount, if any, they pay you for the privilege of holding your cash. That gap between what they pay you and what they earn lending your own money back out is called the interest rate spread, and it's been the core engine of banking for centuries. Your zero-interest checking account isn't a cost center. It's raw material, fuel for a lending machine that runs whether you ever notice it or not. So, if the spread alone covers the cost of running your account, why does the fine print still run for pages? Because of a fee most people don't even notice they're paying, one that never shows up on your own statement at all. Every time you swipe your debit card, the merchant pays the bank a small cut of that transaction called an interchange fee. Economist Fumiko Hayashi, who has studied payment card economics extensively at the Federal Reserve Bank of Kansas City, has documented how these fees, often 1% to 2% per swipe, add up to tens of billions of dollars a year across the banking industry. You never see this fee on your own account. The merchant absorbs it and quietly builds that cost into the price of everything you buy. You're paying for your free account every time you tap your card, just from the other side of the counter. Here's the twist that explains why this whole model can turn genuinely hostile. Economist Victor Stango has spent years studying overdraft fees specifically, and his research found something uncomfortable. A relatively small share of account holders, often people living closest to the financial edge, generate a wildly disproportionate share of a bank's total overdraft revenue. One late-arriving paycheck, one $35 fee stacked on another, and a single mistimed coffee purchase can trigger a cascade of fees costing someone far more than the coffee itself ever did. If you've ever wondered where the real profit in free banking hides, this channel breaks exactly these systems down every week, so stick around, because the next reveal is the biggest one. The Consumer Financial Protection Bureau has spent years tracking exactly this pattern, and their research found that overdraft fees have historically generated billions of dollars annually, with a small percentage of customers responsible for the overwhelming majority of it. The free account isn't subsidized equally. It's disproportionately funded by the customers who can least afford to be funding it. There's also a piece most people never think to ask about: minimum balance requirements. Plenty of accounts marketed as free actually aren't, unless you maintain a minimum balance, often $1,000 to $5,000, sitting untouched at all times. Dip below that for even a day, and a monthly fee kicks in automatically, frequently $10 to $25. For a wealthier customer, parking $5,000 costs nothing. For someone living closer to the edge, that requirement is functionally impossible to meet, which means the fee becomes almost guaranteed. Layer onto this something banks rarely advertise directly: the checking account as a loss leader for everything else they sell you. Once you have an account open, you're far more likely to eventually take a mortgage, a credit card, or a car loan there too, simply because switching banks feels like more effort than it's worth. Banking researchers describe this as classic cross-selling, the same logic a razor company uses selling the handle cheap and profiting on the blades. The checking account is the handle. There's also a regulatory history worth knowing, because it shows how hard banks have fought to protect these fees once lawmakers started paying attention. In 2010, following public pressure over exactly this kind of hidden fee stacking, Congress passed reforms, including what's commonly called the Durbin Amendment, capping debit card interchange fees at the largest banks for the first time. Industry lobbyists warned publicly that this would force them to eliminate free checking entirely. In some cases, that's exactly what happened, at least temporarily, before competitive pressure quietly pushed many banks to reinstate free options. The episode revealed something important. Free checking was never actually free to provide. It was always cross-subsidized by fees the industry fought hard to keep, and when one revenue stream got regulated, Banks simply leaned harder on the others that remained. Put it together, and a checking account isn't really free. It's priced across at least 4 invisible layers: the spread on your deposits, the interchange fee baked into your purchases, the concentrated overdraft fees squeezed from customers living paycheck to paycheck, and the long-term value of keeping you as a captive customer for everything else the bank sells. $0 was never the real price. It was simply where the bank decided to stop showing you the receipt. So the next time you open your banking app and feel good about paying nothing, remember what's actually happening underneath. You're not outside the transaction. You're the raw material powering multiple revenue streams at once, spread so thin across so many corners of your financial life that no single one ever quite feels like a bill. And this same trick, hiding the real cost somewhere you're not looking, shows up in airline tickets, streaming subscriptions, even your grocery receipt. Subscribe, because that's exactly what this channel is breaking down next.